It's Monday, 2nd of March, and this is your Capital Economics Weekly Briefing. I'm David Wilder, and this is what they call in the industry an emergency pod. It follows the extraordinary series of events in the Middle East with US and Israeli attacks on Iran that began early Saturday. What you're going to hear is an edited clip from a drop-in, that's one of our short-form online briefings, that was held for clients at the start of Monday. There's a huge range of issues around this latest episode of conflict in the Middle East, so you're going to hear from our economist responding to some of the more frequently asked client questions. We do now have a dedicated page on our site. It has more on the inflation impacts, on the Khomeini succession question, on the Strait of Hormuz, and the full recording of our client briefing. I will link to that, but the recording you're going to hear has William Jackson, our chief EM economist, Jennifer McKeown, our chief global economist, David Oxley, our chief climate and commodities economist, and Jonas Goltermann, deputy chief markets economist, on some of the core issues that have emerged so far. And it starts with William talking about some of the key risks ahead.
When thinking about the risks going forward, so there are two. One, the first one, kind of the risk of stating the obvious, is the breadth and length of the conflict. We don't have any particular insight into that. We've heard from the US and Israeli officials talk of the campaign going on for somewhere between 1 and several weeks. But I think a lot depends on the extent to which Iran's military is weakened by the attacks. I think the other risk, the second risk to watch, is succession within Iran. After Khomeini's death, there's an interim council, including the president and two other leaders. The president's seen as a relative moderate, the other two are seen as relatively hardline. Then there will be a process to choose the next supreme leader, and that I think remains an open question whether Iran pivots to a more moderate approach, seeks conciliation, or remains with a hardline leadership.
Yeah, that addresses one of the questions that's coming through, is whether we'll see a leader emerge out of all of this with whom the US can do some kind of deal. Much more to get into there from what you've said. But David, let me turn to you just very quickly. Give a sense how are energy markets responding today? And again, following on from what William was saying, where do we see the sort of the balance of risks here?
Yeah, well, I think energy markets are really having to price in a bit of this nightmare scenario of severe disruption to shipping through the Strait of Hormuz. For context, the Strait handles about 20% of global oil shipments, so it's unsurprising to see oil prices rise off about 8% this morning and to around $78 per barrel. It's not just oil either, though. The Strait of Hormuz, the extent to which it carries Qatari LNG out into the wider world as well, means this is transmitted into the natural gas markets as well. So they're actually, the price of European natural gas is up much more than oil. It's up around 20% at the time of speaking. I mean, as to how to think about this, I think the key things to watch would be the extent to which this conflict erupts out and causes damage to actual oil production and export facilities in the Gulf. As we've seen in recent conflicts, particularly the 12-day war between Israel and Iran last year, that energy facilities was really off the menu in terms of strikes. That remains to be seen as the longer this conflict goes on. I mean, that assumption might be called into question. We've already had reports this morning that a refinery in Saudi Arabia has been damaged by an Iranian drone. So that's one mechanism in which this could escalate away from just sort of people having to consider the transit of ships through the Strait. The other thing I think is just worth thinking through and just highlighting is that for all of the discussion of a closure of the Strait of Hormuz, in reality, this is not a binary phenomenon. There's a wide spectrum of things that can take place to affect shipping through the Strait, from relatively low-level actions that we've seen a lot of in recent years, from things like GPS jamming. But as we've seen with these reports about and out attacks on ships, it's clearly escalating. And yeah, I mean, the longer lasting effects would be if Iran really felt as if they wanted to severely disrupt traffic through the Strait by potentially mining the waters, which we've seen at times in the past. So yeah, so certainly the reaction we've seen so far, I think, has been relatively muted in terms of not pricing in the extreme scenario. There's certainly other things that could happen that could push oil prices higher.
Okay, thank you. There are more questions coming in about supply that I want to get to. But from what you're saying, it sounds like the last year's conflict, that's sort of the precedent. That sounds like the kind of pricing that the market is giving in terms of how this scenario plays out. Jenny, let me ask you then, with all that being said, where do we see inflation risks with what's going on?
Okay, well, a useful rule of thumb in terms of advanced economy inflation is that a 5% rise in oil prices adds about 0.1 percentage points to headline inflation. We've seen something like a 15% increase so far, so that would add about 0.3. So not a really major impact. And it's worth noting too that, as you probably all know, central banks tend to try to look through increases in energy prices because they're a one-off impact lasts for a year and then goes away. But the backdrop really, really matters here. If there's a sharper rise in oil prices, which, as David said, is completely feasible, then obviously you get a bigger one-off impact on inflation. And then there's a much greater likelihood that you start to see knock-on impacts on wage growth, on inflation expectations, at which point central banks are more likely to respond, either by not cutting interest rates by as much as they'd anticipated that they would, or in the event of a rise to $100 per barrel, which could add up to a full percentage point to inflation, then you might be looking at actual hikes in interest rates. But it very much depends on what the backdrop is. And you might see a situation where the rise in inflation is dampening consumers' real incomes, dragging on economic activity, and central banks even feel more inclined to cut interest rates. I think the risks for inflation are much higher in economies like the UK, where inflation expectations are already very high. Inflation is above target there, that the Bank of England might be more inclined to slow its loosening cycle as a response to this.
Okay, and then let's go very quickly, let's jump to Jonas and just talk about whether you're seeing anything in financial markets today suggesting that there's concern that this situation could escalate, this situation could worsen, that the inflation risk that Jenny talked about, maybe they're being reflected in markets. How are markets behaving?
Yeah, I think the response so far has been relatively limited. It's broadly similar to what we saw last summer during the 12-day war between Iran and Israel, maybe a little bit worse than that now, but broadly in that ballpark. Risky assets are down, as you would expect. The US stock market futures around 1%, a bit more in Europe. And in currencies as well, the safe haven currencies are doing better. Obviously, the dollar first among them, and the Swiss franc as well. And in bond markets, I think that's maybe the most interesting aspect of what we're seeing. And there's obviously a tension between the impact on growth, but also, as Jenny was saying, risks to inflation, and therefore central banks responding with not necessarily rate hikes, but fewer rate cuts than was previously discounted. And so bond yields, long-term bond yields in US and Europe are actually slightly higher compared to Friday. Now, one reason that we haven't seen that much of response in markets is that some chance of this was already discounted in the market. You'd seen that quite clearly over the past few weeks. Markets sort of quite nervous about the situation, and equities, especially in the US, struggled to break to new highs, for example. So some of it was already expected. And the other, I think, going back to my original point, is the base case, as kind of what Dave was saying about the oil market, is that this doesn't last all that long, and that therefore the right sort of analogy to draw is to the 12-day war last summer. And if you look at a different analogy that's more worrisome, that would be a recent one at least, would be the Russian invasion of Ukraine back in 2022, where the 2022 was a really bad year for equity markets and bond markets, both to sort of stagflationary shock. Now, a lot of that was the whiplash from the pandemic rather than Russia-Ukraine. Russia-Ukraine sort of made a bad situation worse, if you will. I think the starting point, as Jenny was saying now, is quite different. It's a bit worrisome, but nowhere near as bad as we were at the start of 2022.
Someone asking about how the dollar specifically is behaving with regard to lots of conversation, particularly last year, about this de-dollarization trade. Give us a sense of what's been going on there.
Yeah, so the initial response has been a stronger dollar over today and to some extent in the lead up to the conflict as well. And I think that goes a bit against the narrative of de-dollarization and the Trump risk premium, and that we've seen again sort of come back at the start of this year in a milder way, and the Greenland stuff and intervention talk and so on. But I think this kind of situation, it plays into the strengths, if you will, of the dollar and of the US economy. It's a hard power conflict. The US is still by far number one when it comes to hard power. The other important factor is that the US economy, or the US is self-sufficient now in energy. It's actually a small net exporter of oil and gas, or at least gas.
So whereas the big economies in Europe and Asia are all energy importers, so they will be feeling the effects of higher energy prices, especially if they last longer, much more strongly than the US will. The US is a relatively better place to weather this kind of a shock. So that's benefiting the dollar as well. And then you have the fact that the US market is where we had the most rate cuts, pricing is like 2.5 further rate cuts, 60 basis points or so as of Friday. Some of that's going to come out of the market now as you get more worried about inflation, and maybe the Fed and other central banks have got to hold off. So you get a relative shift in rate differentials as well. And final point is that short dollar has been a big consensus trade at the start of this year. And always when you get these shocks, consensus trades are the ones that you have to tend to get hit the hardest. So a lot of things lining up in favor of the dollar in the short term. Now, longer term, I think the effect is more ambiguous. I think you could certainly make the argument this kind of foreign policy decision is going to strengthen the questions around how reliable a partner is the US, and should a lot of countries will be thinking about diversifying from the US, not just in terms of the dollar and then financially, but perhaps also in terms of broader alliances and so on. Can you rely on the US if this is how they're running against international law and norms and so on? Obviously, again, this isn't the first time the US is doing that kind of thing, but I think longer term, the effect on the dollar is a lot more ambiguous.
David, questions here about OPEC, whether OPEC could, if it comes to it, if OPEC's in position to increase supply. Talk a bit about where OPEC is in terms of increasing supply. Anyway, they had this production schedule going on. How their strategy is being affected by this, do you think?
Yes. So, I mean, that's the key part of this. This come alongside a planned OPEC meeting this weekend, which OPEC, to give you some backdrop, having spent a number of years trying to constrain output, they started last April trying to raise output again to claw back market share. They had paused raising output during Q1, and they were widely anticipated to start again raising output at their meeting this weekend. They did do that. There were some rumors actually in light of the news in the Middle East that they were going to really step up the pace. And what they went for was somewhere in the middle. So before all of this started, these strikes started, they were expected to raise output by around about 130,000 barrels a day. There were some suggestions that they could go for a 400,000 barrels per day increase to try and smooth the impact on the oil market. In hindsight, they went for about 200,000 barrels a day. So they're trading as sort of a path down the middle. One might argue whether that's all entirely moot, though, because what we've seen in the last 18 months or so, that a number of OPEC Plus members are really struggling to keep pace with the increase in output quotas anyway. So the two main countries with substantial amounts of spare capacity left are Saudi Arabia and the UAE. And there's a big question mark as to if the Strait of Hormuz was to remain closed or severely impaired, whether they'd actually be able to get their oil to market. So it's a bit of a funny thing to say. Obviously, OPEC massively matters for the oil market, but actually I think OPEC's actions this weekend has not clearly been the key thing occupying oil traders' minds. It's been the closure of the Strait of Hormuz. There's a lot of discussion and a lot of focus on how much of Saudi Arabia and UAE oil output they could actually divert around the Strait of Hormuz. So there is an east-west pipeline in Saudi Arabia that connects to the Red Sea, which has a capacity nominally of around 5 million barrels per day, which on the face of it, Saudi could export, that accounts for about 75% of Saudi's oil exports last year. The UAE also has a pipeline for which it can export around 2 million barrels per day, bypassing the Strait of Hormuz. But I think the key point is that both of these things are operating close to capacity, or more. There's limited capacity for them to be able to ramp them up. And although in practice they will be able to probably get a little bit more oil out, avoiding the Strait of Hormuz, certainly not going to be able to offset the broader loss of oil from the Middle East that you'd see in this scenario. And as I mentioned earlier, particularly the option for diverting Qatar's LNG flows is just not there. So as a closure of the Strait of Hormuz, they can't divert those. So they will remain trapped as such.
William, lots of questions about the regional impact, about the impact on the Gulf economies. Very quickly, just give us a sense of what this means for their economies and how it affects perceptions of these economies going forward.
Yeah, it's really quite a big change in perceptions. Usually, despite their proximity to Iran, the Gulf economies have generally been seen as safe from Iranian retaliation. I think that's really changed over the weekend with some of the attacks that seem somewhat indiscriminate. And obviously the impact and the impact on perceptions and investment flows into the region will depend on how long that conflict continues for, the future political situation in Iran too. But I think this is quite a big challenge, particularly when we're thinking about some of the diversification efforts that are underway in the region. If you think about Saudi with its Vision 2030, the UAE has already got a relatively diversified economy. I think there's a big challenge to the development of their logistics, transport sectors, tourism sectors, if there is a higher geopolitical risk premium that lasts in the region. I suppose sort of thinking more near term, there is some scope with higher oil prices for a fiscal response to cushion the impact on their economies. But certainly, yeah, over the longer term, there's some risks to these diversification efforts that didn't appear to be the case just a few days ago.
William, before we go, I just want to talk about the succession issue, because there is a question we've had about when market pricing could go from the risks around at least disruption of trade through the Strait of Hormuz to perhaps a leader emerging and some kind of deal gets done. You've spoken a bit about how we've seen the emergence of a new leadership in Iran, but maybe just give us a sense there of what the scenario could look like.
I mean, it's all very uncertain. There are lots of scenarios. I think the succession process in Iran works in a way where the former supreme leader had a lot of influence over the people who could choose his successor. So the odds may be stacked in favor of choosing someone who was in Khomeini's mold. That's a possibility. That might lead to more hardline government, but there certainly is a possibility now that there's a shift towards more moderate leadership, particularly when we take that in the context of the US attacks, plus all the anti-regime protests that occurred earlier this year, too. That might be a way in which Iran can eventually pivot towards more moderate leadership that seeks a more balanced relationship with the US and Israel. I might liken that a bit to the situation in Venezuela, where there's sort of existing regime and political systems in place, but under leadership that's more moderate, opening up, reducing political repression, seeking openness with the US. But there's an enormous amount of uncertainty, and right at the moment, the sort of language from Iranian officials is being fiery, so it may take days, weeks to get a better sense of the state of play.
You heard William Jackson there, along with David Oxley, Jennifer McKeown, and Jonas Goltermann on some of the core issues around this crisis. Needless to say, we are following macro and market developments closely and helping clients with rapid reactions, with one-page briefing notes, with in-depth analysis, and of course with these drop-ins, these online briefings. Clients who want are also getting face-to-face meetings and calls with the team to help them work through issues specific to their strategy. If you're not getting the right timely and comprehensive coverage as well as bespoke support and you want to find out more, do drop me a line at podcast@capitaleconomics.com and we can see about setting you up with trial access. No doubt this is the main event in global macro, but the UK Spring Statement is happening on Tuesday this week. The Chinese National People's Congress does start on Thursday, and February US payrolls are out on Friday. So if those issues are on your radar, you'll find all the coverage on our platform, and we'll be back on Friday to wade through them and bring you the latest on these historic Middle East developments. Until then, goodbye.